Hi, this is John Gillingham from LearnDebitsAndCredits.com. Today we're going to be going over 2T accounts, right? So transactions like this, where repurchasing treasury stock, we would decrease cash, do treasury stock, miscellaneous income, receive cash found under the couch. That would be a credit and a debit, okay? So we're going over these transactions, but primarily we're going to be using the Learn Debits and Credits book. If you don't have the book, accountingplay.com/downloads, learndebitsandcredits.com, email me, subscribe, all that good stuff. Let's get into 2T account transactions, where debits equal credits and life is good. So we're going to be explaining this accounting concept that is fairly technical in nature, and it's essentially reflective of a journal entry. So in accounting, there's always two accounts at play. So for example, if I receive cash, I know cash goes up. Cash goes up with a debit. Now where did the cash come from? Let's say it came from a direct cash sale. So sales revenue goes up with a credit, cash goes up with a debit. So always two transactions. Let's say I issue stock. I get the money, debit cash. I issue stock, credit stock. So this is the debits and credits. Now we're going to just drill these small ones. These examples are available to you in the form of templates and otherwise in the book, hopefully free by the time you watch this. Otherwise, email me directly if there's an issue, john@accountingplay.com. Let's get into it. All right. Welcome, where we're going to be going over 2T accounts. Really exciting stuff. So just a quick overview. Here is the ebook resource, and we're going to be using transactions T account transactions that utilize this lovely diagram. So everything's going to have an increase, or I should say a debit, credit. So sometimes it can be increase, decrease, sometimes it can be decrease, decrease, different combinations, but just know for every one debit there's a credit. Debits equal to credits. So going down here, there's a lot of different material. There's this wonderful problem set called Yo Company, and in Yo Company, what happens here is there's several different transactions. So we're going to be covering some of the first transactions, such as receiving $100,000 for common stock, purchasing equipment, credit sales, things like that. So coming down here, something that may be of use to you is the T couple, two different T accounts. You can go ahead and print that out, utilize this however you wish. Now, let's get right into it. Cash and common stock. This is your question. Receive $100,000 investment for common stock. I always say start with cash, okay? Cash is king. Cash is really useful when you need to buy stuff, right? Awesome. So check it out. Increasing cash. Debit cash up, credit down. Okay, I am the business. I'm receiving cash, so I'm going to debit cash up, 100. Okay, now common stock, increase. Equity. Now what's equity? Increase equity with a credit. Now, if you don't remember, as long as you know that cash went up with the debit, the other side has to be a credit. Here are your two entries. It is really just like that. So in a journal entry, this would be essentially the description: receive $100,000 for investment that has been made in your company. So there we go. 100,000, 100,000. If you need to review the schematic of how things increase and decrease, we know that here we have equity up with the credit, cash up with the debit. Debits equals credits. Your equation is in balance. Life is good. Next, purchase $20,000 using a note payable. First thing is purchase $20,000. Did I use cash? No, a note payable. So equipment. Equipment is going up, and I'm thinking debit cash up, debit assets up. Perfect. Let's go ahead and debit the assets up, 20,000. Now, if we can nail the asset side of the transaction down for 20,000, we're going to know that notes payable, or whatever this thing is, if we're only dealing with two T accounts, it's going to be 20,000. So 20,000. Awesome. Owing balance, 20,000, 20,000. Great. Moving on to the next. Now we're making an $8,000 credit sale. So no cash has yet been received. Accounts receivable is an asset. Accounts receivable is basically tracking the money that's owed to you as a business. So you sold something, assuming maybe you just sold your services. Imagine that. So accounts receivable, $8,000. What is AR? Let's think. What if we didn't know what AR is? And we're scouring through all these accounts. We figure out accounts receivable. It's an asset. Perfect. Coming back to here. Let's go ahead and increase 8,000 sales revenue. Credits do increase. Just like so. Now, coming into the final, we have an account presented of cash, 100,000, and accounts receivable, 8,000. Now, if you saw all the different accounts, all the debits would equal the credits, but this $100,000 I just put in there because $100,000 was received via a debit to cash and a credit to common stock. So we have a starting balance here. Now we're collecting $8,000 from a credit sale. So we know we should always start thinking about cash, right? So let's think about cash. Debit cash. Should we debit, collect? Okay, yes. 8,000. Wonderful. Now accounts receivable, check it out. We are crediting, reducing it. So we're trading an asset for an asset. And we can come up to our balances here. We have a 100,000 plus 8, total of 108,000. $8,000 that was tracking the amounts due minus this $8,000, just like so. All right? If you need help, go back to your ebook, look at your schematic, and go from there. So, we just started to talk about really basic kind of in a vacuum transactions where involving two T accounts. Sometimes increase, decrease. It just depends on the nature of the transaction. Just know that debits equal to credits, debits equal to credits, and debits equal to credits. Then you should not get that problem wrong. Start with cash. Cash is a credit, the other side is going to be a debit, and vice versa. You can kind of get the flow. You are the business. And also, don't forget about trying to play with the game. Just show you right on my iPad. Let's say I'm on the bus or whatever. Receive additional investment. I know cash is a debit. I know additional paid in capital is going to be a credit. Buy coffee with office money. Cash goes down. Petty cash is cash. Credit cash down. I automatically know this is a debit, but meals and entertainment is going to be an expense account. So let's go ahead and go there. So what I've done here on the debits and credits game for iOS is I chose just one T account. Excuse me, two. So by having two, I was able to just focus in on the two accounts. So thanks so much. This has been John. Subscribe, john@accountingplay.com. If you can't find any of these materials for free, email me. We'll see what's going on there. And I want to hook you up. So thanks so much.